Hello everyone. Edzergia and the D Talpa channel. If the episode was useful, please like and subscribe. This channel is very helpful. Please write comments. How do you like the release? Maybe there is something he needs to explain differently or add something. I look forward to your comments, good and bad. Thank you all for subscribing too. Short week on Friday. The market in the US is closed. Now let's collect what really happened in the market. Where was the money? Why did DAX skid us? But the broad market held on. What to watch next week? There will be training at the end. Today the topic is indicators. Let's go. What really happened in the market? Let's look at the pictures. Which one? Nasdaq via QQ went into negative territory by about 0.5% over the week. S&P 500 via SPY plus 1.4%. Dow Jones plus 1.7%. And RSP equalized S&P 500 plus 1.5%. Here's the highlight of the week. If you look only at QQ, at Nasdaq, you can say Nasdaq is weak. But if you open the S&P, Dow and RSP, you see something else. The market has not collapsed. The broader market held the Dow in the green, the SPY in the green, and the RSP in the green. And QQ is weaker. So it's not panic, it's like rotation. The money did not come completely from the market. They began to move from one story to another. Why is the sign important? SPY is a regular S&P 500, with large companies heavily weighted. Apple, Microsoft, Nvidia, Amazon, and so on. And RSP is the balanced S&P 500.
There the companies have approximately the same weight.
And if the sign grows along with SPY, then the movement is wider. Not just a few giants, i.e. the whole market. And now RSP plus 1.5%, SPY plus 1.4%. That is, there is width. But QQ, Nasdaq, minus 0.5%. And this is already said by the old leaders, especially Nasdaq, AI. The chips began to box. For this was especially visible. Dow closed strongly, SPY almost stood still, back went down. And most importantly, the weakness was in semiconductors. Chips were sold. AI stories started to get nervous, and this is not a small thing. Because chips are one of the main stories of the market. AI is about the center, memory, Nvidia, Micron. This whole chain, if this group starts boxing, means the market is no longer just buying everything related to AI. They begin to choose. Now let's look at where the money actually went. Crypto lived Bitcoin through IBIT for the week, plus 3.9%. Ethereum plus 9.3%. That is, interest in risk has not died. But this does not mean that in the iFair market. More likely, there is a risk, but it has become selective. Not everyone buys. They buy specific topics. The leaders of the week also show this. Cybersecurity plus 12.7%. Insurance brokers, 8 and 3%. Genomics, 7 and 1%. Biotech also held on. The fate of those was also in focus. That is, the money was not just sitting in megacaps. And not only in AI. Stomp looked for other pockets of power. Where's the movement? Where's the story? Where's the chance for a sequel? And here it is important to look not only at the week. One green week is not a trend.
I'm looking at a month, 3 months, and only then the last reaction. Because if the tool fired once, it could just be noise. And if he stays in the lead for months, there is a real flow of money there.
Genomics for 3 months plus 50.9%, for a month plus 26%, for a week plus 7%. This is no longer a random candle. This is a topic that the market really cares about. Biotech and pharma are also strong. For 3 months plus 25%, for a week 5 and 8%. Insurance brokers for 3 months 17%, 0.5%. And the week was also positive. The market did not grow everywhere. It was equally busy. Obiotech, genomics, insurance brokers. Cyberobia stock. Cryptocurrency looked better. The crowd fled from the market. The crowd was changing direction. Now the question is, what looked bad? The first TUQQ, back 100 is weaker against the background of S&P. You can see it right away. Not a disaster, but a weakness. If UQ continues to lag behind, then the rotation from back can continue. The second is semiconductors. The four sold strongly.
This is simply taking profit after a big increase.
Or maybe the first signal that the crowd has become crowded due to overheating and AI history. While I would not draw big moving conclusions, but this cannot be ignored. Because when big leaders start to fail, the market can quickly change character. The third is energy and oil. Oil through UQQ for the week asked for almost 5%. This is a two-story story. For part of the market, cheaper oil may be a plus. Less pressure on inflation. Less pressure on costs. But for the energy sector, this is a minus. Therefore, one cannot simply say that the oil supplied was good. We need to see who benefits from this and who loses. In the fourth, metal and retrofittation. Lit went into negative territory by almost 2%. This is also a weak area. If the market is really in pure risk, I would like to see the participation of series, metals, and cyclical stories. And here some of these zones are stalling. This means that there is an appetite for risk, but unevenly. Money flows pointwise. And more gold. GLD for weeks plus 2 and 3%. If stocks rise, but there is also demand for gold. This suggests that someone is insuring anyway. Not necessarily panicked. But this is not a market where everyone just closed their eyes and ran to buy risk. This week's conclusion is as follows. Leadership exchanged. If previously everyone looked through Nasdaq, AI, and chips, now we need to look more broadly. At the same time, monitor whether to continue to mux UQ and semiconductors. Because if the old leaders break and the new ones hold on, this means rotating.
And if new leaders also start asking questions, then there is a risk for the entire market. Now macro.
The main question is why the market received support at all if Nasdaq is weak. Reply, JAPRI, port, employment report, and rates. The jobs report came out this week. Fewer jobs were added than expected, 57,000 versus expectations of about 110,000. Unemployment is about 4 to 2%. This is an important figure for the market. Because the labor market is weaker, there is less fear that the Fed will act joyfully. If the economy is overheated, the Fed may keep rates higher.
If the labor market cools, the pressure decreases slightly.
Therefore, the debt of a wide part of the market received support, but Nasdaq still asked.
Why? Because macro can help the overall background. But if chips are already overbought and profit-taking,
JAPRI report alone will not save the entire sector. This is an important point. Macro gave the market air, but did not cancel the weakness in overheated stories. Now the bets. Now the 10-year 3 is the same with about 4.5%. But the drop is not about 4.1%. Simply put, profitability is the price of money. The higher the yield, the more expensive the money. And when money is expensive, it's harder for a company to grow, especially those where most of the anticipation sits in the future. That's why Nasdaq, AI, chips, and company growth are so sensitive to rates. Let me remind you that rates are closer to 4.5%. This means that many investors think, why should I go for some risky assets? I can sit on 4.5% a year. The dollar also weakened after the weak data. For risk-taking, this can often be a plus, but again, this is not a guarantee. You need to look at the profitability link. Dollar, QQ, RSP, or weeks. The JAPS report has relieved some of the pressure on rates. This helped the wider market, but the yields are still high. 10 years, for 0.5, that's not cheap money. So if yields go up again, Nasdaq may start not to grunt again. And if it stabilizes the yield, the market may continue to rotate into broader sectors. What to watch in the coming weeks? I wouldn't look at everything, but for several checks. The first check is RSP versus SPY. If RSP continues to hold, no worse. So the market width is alive. If SPY holds RSP, begins to get up, means the market is shrinking again. This is worse. Second check, QQ. Nasdaq is already weak. Now a question. They'll buy him out, or he'll continue to stall. If QQ keeps getting up, means that the rotation from Nasdaq continues. Third check of the chips. This is the main nerve now. 4 of them were heavily sold. Look, this is just profit-taking or the onset of more severe fatigue.
If semiconductors are bought back quickly,
the market can tell. Okay, that was a rejection. If weaknesses continue, then you need to be more careful. The fourth test of profitability. If they go higher, this is again pressure on a growing company. If they calm down, the market may continue to rotate.
According to the calendar, next week more than one Fed-level event, which previously rented out tons. But the market will still read any data via rates, housing data, corporate events, anything that can shift yields. You can watch SK Hynix separately and related stories around memory, AI, and data centers, because if the market accepts it normally, such semiconductors of history, after the weakness in the chips, this is a good test. And even if it's about weakness, means the crowd is more careful. The main question for next week is simple. This is a normal rotation, when money smiles from an overheated Nasdaq into the wider market. Or this is the beginning of fatigue, when old leaders stall at first, and then the weakness can spread wider. Check this out too. Now the scenario is not a forecast, a control panel. What to watch to avoid guessing. Bullish script. It works if the market continues to expand, is staying asleep. Dole holds on. RSP is not lagging behind. QQQ stops slipping, and at least not soon from the fall. Chips are stabilized, just landing. The RICs remain calm. Donuts don't fly up. And leaders like biotech, genomics, brokers, insurance, security is no longer broken. Then you are simple. The market has digested the weakness. At Nasdaq, money did not leave the market, but simply flow into other sections. Second, that's normal. Non-poisoning sun. This is when the market is simply almost there. It's worth singing. QQ twitches back and forth, but it also stands almost still. RSP is holding. VIX does not grow dramatically. Yields are around current levels. Leaders don't grow either, but do not roll back. There is no need to rush in this mode. Today the signal is up, down tomorrow, then up again, then down again, and the little one starts jumping back and forth. And the market is simply shaking. It's better to watch here. Levels, volume, and relative strength. If nothing breaks, you can just wait. And the best deal, this is not included. Bearish scenario. If the market width begins to break, the adhesive holds only in individual giants. RSP is starting to lag behind. VIX begins to grow sharply. Yields are going up again. QQ breaks through important levels. And the leaders of recent weeks are beginning to give up. Then it's no longer just rotating. This could be risk aversion. And this is important. Don't think about every candle. Well, now it will definitely bounce off. First, the price must show to buy or actually appeared. And only then can you think about the entrance. Let's move on to training. Today I want to talk about indicators. MACD, RSA, moving averages, 100 Stochastic, Bollinger bars, and trends at the end of the line. I'll try to show the most popular things, which are often used in charts. Let's first understand what such an indicator is. And in simple terms, an indicator is a calculation. This is not a fortune teller. A regular indicator takes data that are already on the market. Price, volume, time, maximum, minimum, closing price. And then, using some formula, they show you a line, bars, or a number. That is, roughly, an indicator is mathematics drawn on a chart. For example, not just the price itself, but the average price, or how much the price has moved away from its normal range, or where the price is within the range for the last candles. Important, the indicator does not know the future. He doesn't know what will happen next. It takes past data and current data, counts them, and shows you the result. That's all. Often a person thinks there is some kind of secret indicator, but almost all popular indicators have long been known. They are available for free in almost any broker. They are in TradingView. They are in Vibu. They are in another application where you use them. Not PCI, not Magda, not invented yesterday. Moving averages, stochastics, poles, Bollingers are also no secret. Yes, of course, I think that the fonts where millions and billions are managed could have its own models, its own algorithms, its own calculations, its own analysts. But that doesn't mean there's one secret line somewhere that's always talking. Buy here, sell here, there will definitely be growth here. That's not how markets work. And I'm not saying that indicators are bad. No, indicators can help. They can highlight a movement that suggests a trend, show that the market is overbought or oversold, or that volatility has increased. But the indicator is not the brain. It's not a strategy, it's not a guarantee, it's just a tool. It's like a ruler. A ruler can help you measure, but a ruler won't decide for you. It will simply show the distance. Here is the indicator too. He's just showing something, but you still make the decision.
That's the problem with newbies. They think, I'll now find the right indicator, I'll start making money. But the market doesn't work that way. Because the indicator usually takes what is already on the chart, price, volume, time, often recalculates this into a beautiful line. This is not a fortune teller. This is most often a derivative of price. The price has already moved, the indicator has worked out this, and drew you a line. Therefore, if you understand the price, volume, levels, and risk, then the indicator is not a salvation for you. This will just give you another beautiful line along which you can make a mistake. Let's put it in simple terms. The first popular indicator that tells about the average, moving average. Often you will see a MA or SMA. SMA is a simple, telling average. It simply takes the average price in a certain period. For example, the average price for 20 candles or 50 candles or 200 candles. If the daily chart is 200 MA, this is approximately the average price for 200 trading days. The meaning is simple. The price keeps changing. Up today, down tomorrow, then up again, then down again. The askance middle smooths out this noise. You can roughly see the direction if the price is above average. It is often said that the market looks stronger. If the price is below average, weaker. If the short average crosses the long upper, bloggers often talk about bullish signals. If down, the signal does not move. But intersection is not a guarantee. The price may stop the average upward and then immediately return back, and it will carry you out, especially if the market is sideways. When the price just wobbles with a long here, with each average can often give a bunch of false moves and exits. Looks like we crossed paths. We buy, then down, sell, then up again, then down again. There is also IMIA. This is an exponential moving average. It sounds complicated, but the meaning is simple. IMIA often reacts to the latest prices. That is, the usual IMA is calmer, slower. And IMA is more fast and sensitive, if the price went up or down sharply. IMA will begin to follow her faster. Therefore, traders often use IMA when they want to see changes in movement faster. Well, there's a trap here too. The faster the indicators react, the more, and there can be nested signals. Because the price has changed, the IMA is already reacting. And you might think he started moving, but it was just normal noise. Therefore, MA or IMA are no worse or better. They're just different instruments. MA is calmer, IMA is faster. And we can't just say, we buy at a price above average. No, you need to look where the level is, where the volume is. Where is the stop? The market is now, trending, or just counting here. If it doesn't, it's not a strategy, it's just a line on a graph. Now MACD. MACD loves to show off. Because it looks beautiful. 2 lines. Histogram. Intersections. Beautiful, smart, seemingly serious. But to put it simply, MACD is trying to show momentum. That is, the movement accelerates or weakens. Inside MACD, 2 telling averages are usually compared. Fast and slow. That is, one reacts faster to the price, the other slower. And MACD shows the difference between them. Plus there is a signal line and a histogram. These are these columns. The bars help you see whether the impulse is strengthening or starting to weaken. If the bars rise, the momentum may increase. If the bars decrease, the impulse may lose strength. But again, MACD does not know the future. He looks at what the price has already done.
If the movement has already begun, MACD can show that there is momentum. If the movement weakens, MACD can show that momentum is being lost.
He's late. You can see the beautiful intersection after how a good part of the movement has passed, and the man looks about MACD gave buys. The price has already flown away, and then there is a reversal, and the person is such a bad indicator. Then no, maybe. The indicator is normal. You just used it as a magic button, and it's not a magic button. MACD, you can use a hint. For example, there is movement, there is volume, there is level, there is understandable stop, and MACD confirms the impulse. Okay, this could be an additional plus, but if MACD just gives a beautiful intersection of volume, no level, no stops, it's not clear where you are at all. You don't understand why you're leaving. What this MACD gives you is a beautiful line. Thank you, but beautiful lines do not guarantee money now. PCI, is also a very popular indicator in simple terms. Words PCI show the strength of the price movement. It is trying to show the price has already risen too much, or RSI has fallen too much. Usually moves from 0 to often it is explained as above 70 overbought. Below 30 it is oversold. That is, if above 70 the market seems to have already accelerated strongly upward. Below 30 seems to have already been pushed down a lot and he thinks, yeah, if the PCI is above 70 then it means you have to sell. If it's below 30, then you need to buy. But this is a dangerous move because in a strong trend, PCI can last for a long time. Be overbought and continue to grow, and you sit against the traffic and think, but when will it? The same thing will fall down RSI. Maybe below 30 you think it's oversold you should buy, and the stock is falling even more. 10, 20, 30%. Why? Because bad news, because there is no volume, because there is a crowd. It turns out that's why PCI is not a purchase. This is another hint now the stochastic is normal when. Saying stochastic means stochastic stellata sounds scary, but the meaning is simpler. Imagine that the price. Over the last few candles it was moving in some range, it was up, it was down, and the stochastic is trying. Show the price now is closer to the top of this range, or closer to the bottom if the price is closer to the top. Stochastic is high if the price is closer to the bottom. Stochastic is low, that is, it does not say exactly buy. And doesn't say exactly sell, it just shows where the price is now within its recent range. Usually there are two lines, one faster, the other more smooth. And people are watching at their intersections. If 100 is hashtag below or not, turn upwards, indicating a buy signal. And if 100 hashtags are at the top or don't turn down, talking about a sell signal. But I'm tired and that's the same problem. This is not a guarantee. STA hashtag can be useful when sob on the side, when there is a clear corridor from below buy, sell from above. The price goes back and forth. That's where 100 hashtag can sometimes help you see that the price has reached the top or bottom of the range. But if the market is in a strong trend, 100 hashtag can take a long time. Hang at the top or bottom, and it will be the same again problem. The indicator says expensive, but the market goes even higher. Or the indicator says cheap, but the market falls even lower. This is why you are sitting against the trend. Why? Because you believe the indicator more than the price itself. Now for the Bollinger Bands. Bollinger Bands. Frequently say the Bollinger Bands. This is also popular thing. There is usually a middle line and two stripes above and below. If in simple words these stripes show how far the price has moved from its usual movements. When the bands contract, the market seems to become calmer. Volume is lower, price moves in a narrower range. When the stripes are expanding, which means the movement has become sharper, volatility has grown. Some people look, the price has reached the top. Stripes means expensive. The price has reached the bottom. Stripes means cheap. But here again, it's impossible. Thinking is too simple. In a strong trend, the price may long walk along the upper border. And you every times you sell because the price has already touched the upper limit. This could be sick. Same thing down. Price can go along the lower border. And you will think, it's time to buy the lower band. It's falling further. Therefore, Bollinger Bands are not a signal. Exactly buy or definitely sell. They're more likely to help understand whether the market is calm or sharp. The price has compressed or stretched out. Volatility rises or falls. Now, trend lines. This is no longer quite an indicator. It is more of a charting tool. You draw the line yourself and try to understand the movement. And I think it's one of the main tools that a trader or the investor should at least understand. Because the line of a trend helps to see the direction. If the trend up, usually the line is drawn along the lower points. Then the price rises, then rolls back, then is growing again. Then it rolls back again. And you connect these rollback lines. It turns out upward line. It shows the place where buyers began to support prices earlier. If the trend bottom, the line is often drawn along the top points. Price falls, bounces, falls again, bounces away, and you connect these top one's points. This results in a downward trend line. shows where sellers used to put pressure on the price down. The meaning of a simple trend line helps see the direction. But you don't have to do it here either. Xenia magic. Line can be drawn in different ways. One the trader will carry out this way, another slightly higher, another just below, and everyone will think that they are right. Therefore, the trend line is a concrete wall, it is rent. If the price has touched this line many times, bounced off it, volume appeared there. Then, this place is getting interesting. It's already possible there. Watch. Will there be a rebound? Will there be a breakdown? Will it appear? Either the buyer or the seller will continue to press price. But if you just drew a line where hit, it doesn't mean anything. And the breakdown line of a trend also does not always mean all reversals. And got tired of breaking the line, then returned back. And everyone who hurried was simply carried away. The trend line helps to understand the direction, but the entry still needs to have a plan, where the level is, where volume, where stop, where I will be wrong. If this is not the case, the trend line itself is not a strategy. And now the main question is why then these indie stills are shown so often bloggers because they are easy to show. Opened. Schedule, set MACD, set RSI. Put two lines, broke the trend line, and that's it. Looks smart. You could say I was here signal, here you should have bought here. Would have to be sold. This is especially true in history beautiful, because when the schedule has already passed, always you can find the place where the indie footage worked. Here the MACD crossed, here the RSI left the zone, here the average supported, here the trend line held on, and it seems, well, everything, the strategy is ready. But the problem is that in real time you don't know what candle will be next. It's all about history is understandable, but not at the moment. And this confidence often sells subscriptions. They show the past graph where everything is perfect, where the arrows are perfect, got where the indie footage showed perfectly. And then they say, if you want such inputs, subscribe. And so here you need to use your head. And if all this was so simple, why sell a subscription? What are we just? Don't press buttons and don't print money. I'm not saying that subscriptions are bad. No, maybe normal on Lytic, maybe normal. Explanation, maybe the person is real, shows logic, risk, mistakes, stops, where he was wrong. This is one thing. But if they sell you idea, here's the secret indie footage that always shows the entrance, I would immediately be careful that. Because that's not how the market works. For me, the normal order is this. First the price, then volume, trend, level, risk, and then only indie footage. On the contrary, they are not. RSS said I bought. And so there is movement, there is volume, there is level, there is a clear stop, and indie shots do not argue. Ideas. That's when indie footage can be extra a clue, but not the main brain of the deal. And it's important the more indie frames you put on the chart, you won't stop me. Sometimes it's the other way around for you could, where he says, buy, RSS says, he's a little careful. Stochastic says, sell, average says sideways, Bollinger stripes say, prestige, trend lines seem to be held by you too. You sit there, so what should you do? Nothing. You just messed up the chart. You can't even see the line now, the price itself. For eternity, it often seems the more indie shots, the more professional, but professional, this is when it is simpler, price, volume, level, trend, risk, and maybe 1 to 2 indie frames. If they really help, they are 10 pieces to make it happen. Beautiful. Aloyka, what kind of indie shot will he direct? For him to tell me to buy, this is the way to subscribe, courses and disappointment, because you give responsibility to the lines on the screen. Responsibility is still on you. If you bought it, it's your deal. If there is no stop, it's your risk. If you be